Rate cuts. It's the expression that we have been listening more and more these days. We need to remain data dependent so we remain credible. That's my main concern. Of course, if you look back and you go, say, to the beginning of June last year, you see that you now are much closer to that moment than you think it'll be by then. The reason for that is we've been surprised in the downside quite a bit with inflation. So the trajectory is good. It's what we want, inflation to come down. It's not only headline, core and services inflation are also coming down. This is very important. Actually, there's one thing that I think it's important for us to notice. Services inflation goes down much slower than headline. This is a typical pattern. But this time it is going down twice as fast as it went up. So things on that perspective look good to our goal.
Your colleagues in recent days have been mentioning summer as a potential time for the change in policy. Do you think that's reasonable or too late?
Well, we are data dependent. We are not calendar dependent. That's a very important thing always to remember. Being data dependent, we need to bring all data on board. And there's plenty of data out there. We already mentioned inflation numbers, but go to the economy. The euro area economy is not growing for 5 quarters in a row. The fourth quarter still looks pretty stagnant, and the first quarter of 2024 is really a challenging quarter in terms of growth. So we need to remain focused on our goal, which is to have inflation at 2% in the medium term. It's not on February, it's not March, it's the medium term. And the good thing about the euro area throughout all this process of inflation is that expectations have been anchored pretty much at 2% in the medium term, and that's a sign of success.
Do you see a need for the ECB to undershoot inflation for a bit to compensate, or is this a risk that you're prepared to take?
We need to avoid that. The goal is 2%, and we need to carry a policy trajectory that takes us to 2%. If we undershoot, that's not our job. We must remember that for more than 8 years prior to this inflationary process, average inflation in the euro area was 0.9%. This was much lower than we aim at in the medium term. So we should definitely avoid undershooting inflation.
Markets instead have been very optimistic, or very bullish about the possibility of ECB rate cuts. They are pricing in several rate cuts this year. I think 4 was the latest. Are they being too optimistic, or actually are they being data dependent as you are?
Oh, I hope they are data dependent. They have their own analysis. I'm not going to comment on market perspectives, but we are following all these figures. It's really something that we have to take together. Financial stability is also very important for us. This is also one of the reasons we have been successful in this process, because we were able to keep financial stability as we always like it to be. It's a precondition to price stability, actually, and that's the whole package we need to follow. So markets have their own perspective. We have numbers that we put together every 3 months, every time we have a new forecast. My main message is we have to read the data. We have to report this information, to communicate, and then we have to react, which is we need to set a policy. These 3 R's, read, report, and react, is how we need to continue because predictability and credibility are very important to increase confidence in the euro area. Sentiment indicators are low. We have also very low PMIs in the euro area. It's not only manufacturing, services sector is also not doing well. We need to turn this around.
When you mention about your credibility, do you think that the quite differing opinions that are emerging from within the governing council are impacting this, or I mean, what's your assessment of the of the mood within the governing council?
Not at all. That's why we are 27. So we need to bring in fresh ideas, debate. The discussion is always very open. The main focus of everyone is, I'm sure, the same, and that's what brings credibility.
Let me just ask you two questions about inflation, because of course it is been going down, but there are some factors which are actually upside risks for inflation. There is the crisis in the Middle East with the impact on supply routes, on trade, and potentially also on energy. And then there is the very solid, also, I would say, very tight labor market in the euro area. What's your assessment?
The first topic is based on scenarios. We have scenarios. It's not on the baseline, so we don't have that on our baseline. We have to measure the risks every time we take decisions and be sure we are doing that at all times. So these are scenarios. It's not on the baseline. The labor market is a different story, because you are absolutely right. It is a tight labor market, but it's also one of the greatest successes of Europe in the last 2, 3, actually probably a little bit more. Over time, labor market in Europe developed bigger, so you have a higher participation rate, much more flexible. We have much more new entrants into the labor market. Migrants make up 50% of employment gains in Europe. And we have unemployment duration going down quite substantially. So all these hysteresis type of indicators that we traditionally associate with the European labor market, they changed quite significantly. And that makes the tightness of the labor market more difficult to gauge when we look through the old lenses that we used to apply to the European labor market. So I am confident that wage developments in Europe will be compatible with lower price pressures. We have actually -7 percentage points in real wages since the beginning of the inflation crisis in Europe. -7, it's a big decline in real wages. We can only expect this to recover gradually over time. That will be the best thing for Europe. But I don't see many reasons for concern there, honestly.